Hi, and welcome back. I'm Angela Barbash, and in this video, we're going to talk about how community investing may fit into your overall financial plan. Now, you may have had experiences in the past investing in stocks or bonds or various mutual funds. Community investments are very different from those kinds of investments in some important ways. The first thing that you're going to want to look at is your overall capacity for risk. Now, when you're thinking about your capacity, there are three important areas to consider. The first is, what is your overall time horizon for this money? Meaning, when do you need to use this money, or when do you need it to be liquid? Second is, what is your financial capacity for risk? In other words, how much can you afford to lose? That's always an important thing to look at when you're investing. Third is, how would you feel if you actually lost this money? Now let's dig into that one a little bit deeper. So, first ask yourself, how would you feel just even thinking about the idea that you could lose your money? Is it more down here of kind of distressed, or is it down here of really distressed? The second question you want to ask yourself to really gauge your emotional tolerance for risk is, what would you do, or how would you feel if you actually lost your money? More down here or more down there? If you're thinking that how you would feel would really depend upon how much you lost, then stick around, because we're going to dig into that a little deeper.
I think that the amount of risk that I am taking and that Mike is taking is something we can deal with.
We're fairly diversified. We have money in stock, we have some rental properties, and so this is something we'd like to do and we can afford to take the risk. We have talked to these people and we trust them. We know kind of what they're doing. We know they have some good ideas and good plans, and they can run their business pretty well.
Every one of them is so passionate. They're not only just passionate, but they have a lot of ideas. They put a lot of work into it. We can see that. So that gives us hope that what they're doing is going to come to fruition.
Another important question to ask is, where is this money actually coming from? If you've been saving for retirement, you probably have two kinds of money. You may have non-qualified money. That is money that you've already paid taxes on. And it may be sitting in your checking account or savings account. Or it may just be in cash, maybe even under your mattress. The second kind of money that you may have is qualified money. That is money that you've not paid taxes on, so it's pre-tax money. And think 401k, or the most common, IRA money. If you're going to use qualified money, there's several very important things that you need to know, because there's restrictions on that kind of money. You may be familiar with custodians. Those are companies that manage accounts, whether they're qualified or non-qualified accounts. Companies like Fidelity, Vanguard, or even TIAA. But those kinds of custodians don't want to deal with community investments. And it's important that you do find a custodian if you're going to use qualified money. It's important that you do find a custodian that will work with community investments. Now, these custodians are called self-directed IRA custodians. And you can go visit the Grubstake website for a list of custodians that operate in the United States. They're going to help you make sure that you're following the rules, because the penalties for not following the rules can be very high. So we don't want to make any mistakes there. Let's talk about those prohibited transactions a little bit more. The IRS has a very specific list of things that you can and cannot do with your IRA money. You can go to their website and get a list of all the things. And you'll really want to make sure that you are working with your custodians and your tax advisor to make sure that you're not violating this list. First and foremost, you cannot invest in your kids. You cannot invest in your parents or your brother or your sister. And you cannot invest in yourself with your own IRA money. You can't invest in your own company or buy a building that you're going to own with your qualified retirement dollars. It's very important, again, that you consult your custodians, your tax advisor, and even check out the IRS website to make sure that you're not violating these prohibited transactions list. It can be very costly in taxes and penalties. My friend Kathy has done this. Let's hear how she did it.
Mike or I did not really understand how to shift money from our IRAs to investments. And we have since learned that there's a platform that you use and a custodian that helps shift that along.
So it can keep all the tax benefits of being an IRA.
That's the beauty of working with somebody who knows how to help us take our money from our IRA and shift it over to investments. And there's a couple of steps along the way.
We vet the companies, talk to the owners and see if we like to do that. And then actually we do it online to move the money from our current IRA to another one to invest in those companies.
Remember, you may be very excited about community investing, and we are too, but this series is really for educational purposes only. It's not an offer to invest, and it's not a form of marketing. All investment carries risk, which is why it's so important that you get together with your team of legal, financial, tax, and accounting professionals as you make these decisions. Community investments, they do not necessarily mean you're going to get a higher return for the amount of risk you're taking like you would if you were investing in publicly traded markets. It's very important that you understand that community investments could carry higher risk, and we're going to continue to cover that in the videos that are coming up. We really appreciate that you're excited about this and that you're on this journey with us to consider how you can make an impact in your community.